Walmart just raised prices. Then it fired 1,500 employees. And Trump, he's furious, publicly accusing America's biggest retailer of betrayal. This isn't politics. It's a $648 billion pressure cooker blowing its lid. What if this is the moment the entire U.S. economy flinches? Because behind those layoffs is a deeper crack, one that Wall Street's watching consumers are feeling and Washington can't control. If Walmart, the king of low prices, can't survive Trump's trade war, who's next and what's about to break? On May 17th, Trump took to Truth Social, accusing Walmart of betraying American consumers after the company raised prices due to surging import tariffs. They're hiding behind tariffs, he wrote, warning the retail giant to eat the cost or face public fallout. But that message collided with hard math and a politically inconvenient truth. According to the Bureau of Labor Statistics, inflation-adjusted prices for food at home rose 2.6% year over year by April 2025, and over 68% of Trump's rural-based shops regularly at Walmart. The criticism ignited online. But for many voters in the Midwest, the more urgent concern was that eggs, diapers, and jeans were suddenly outpacing wage growth. Walmart sources over half its goods from China, and with Trump's reimposed 25% tariffs on those imports kicking in last month, the price hikes were not strategic. They were survival. And yet, even as prices ticked upward, another question emerged. If Walmart's the villain, why are other retailers following the same playbook? The rhetoric may be political, but the numbers are clinical. According to a 2025 Brookings Institution report, 94% of the tariffs imposed since 2018 were paid by U.S. companies, not foreign exporters. Walmart, operating on a 4.3% profit margin as of Q1 2025, faces a narrowing window to absorb added costs. When those tariffs hit a Chinese-manufactured vacuum cleaner or a toddler's car seat, the surcharge isn't absorbed. It's passed to the end buyer. Bloomberg reports that importers are now paying nearly $12 billion annually in cumulative Trump-era tariffs. Meanwhile, a recent NBER working paper found these costs reduce household consumption by an average of $213 per quarter for lower-income families. Walmart, often seen as the final buffer before economic hardship, isn't dodging duty. It's transmitting Washington's trade bill directly to the checkout line. And that line's growing shorter as shoppers downshift their carts or walk out altogether. But if Walmart can't shield customers, who or what can within days of Walmart's public clash with Trump, other giants move to insulate themselves? Target cut its earnings outlook by 12%, and Best Buy cited external cost volatility as a material risk in its May SEC filing. Walmart notably withheld Q2 profit guidance altogether. An almost unheard-of move for a firm that generated $648 billion in revenue last fiscal year. Treasury Secretary Scott Bessent, testifying before Congress on May 20th, admitted that tariff pressure has a delayed but direct correlation to consumer pricing models, undermining the administration's claim that foreign governments are footing the bill. According to Morning Consult, polling support for Trump's tariff policy dropped 9 points in swing states over the past 3 weeks. And with Amazon quietly tweaking its pricing transparency while avoiding the tariff debate entirely, the retail sector's message is clear. This isn't politics. It's logistics. But while executives recalibrate, pressure is building inside Walmart's own operations, and the next shock would come from within. On May 21st, Walmart confirmed it would eliminate approximately 1,500 corporate jobs, focusing on its global tech and Walmart Connect divisions. The company cited agility and modernization as its rationale, but the timing, less than 1 week after Trump's public attack, raised eyebrows. Internal memos obtained by USA Today revealed that these roles, largely based in Bentonville and Seattle, were being cut to streamline decision-making across end-to-end operations. Notably, this comes as Walmart integrates Vizio after a $2.3 billion acquisition to expand its advertising reach, signaling a pivot toward automation and digital monetization, while Nick DeMoss, Walmart's VP of Communications, denied a link between the layoffs and tariffs. Former Walmart strategist Mike Kesley told Reuters that cost pressure from tariffs accelerates decisions already on the table. The affected workers aren't warehouse clerks. They're the algorithm builders, the data optimizers, the ones designing the very systems that once gave Walmart an edge. And without them, that edge may dull, just as the retail battlefield gets bloodier. Walmart's stock fell 3.1% following the layoff announcement and price hike disclosure, wiping out over $9 billion in market cap in a single trading day. Analysts at J.P. Morgan noted that Walmart's inability to buffer tariff fallout suggests broader consumer demand fragility. Meanwhile, consumer sentiment, as tracked by the University of Michigan's index, dropped to 68.4 in May, the lowest since January, driven largely by rising retail prices and economic uncertainty. Target's shares slid 2.8%, and Home Depot issued a cautionary note about inventory strain as supply chains readjust around tariff rerouting. Even dollar stores are reporting compression in discretionary categories, like home goods and electronics, according to a May 22nd report from Fitch Ratings. The message to investors: if Walmart, a company that moves 37 million transactions per day, can't absorb tariff shocks, then the rest of the retail economy is skating on glass, and under that glass, a potential consumer contraction that could redefine the second half of 2025. Walmart was designed to be recession-proof, a fortress of scale and logistics that could swallow cost pressures and spit out low prices. But when that fortress starts shedding white-collar tech jobs and skipping earnings guidance, it signals something deeper. As of May 2025, consumer credit card debt surpassed $1,031 trillion, according to the New York Fed, and retail foot traffic is down 11% year over year in value segments, according to Placer.ai. These aren't indicators of strategic repositioning, they're warnings. The narrative of tariffs as economic leverage is unraveling in real time, and what's left is a market reacting faster than Washington can rationalize. If Walmart can't stay stable in a U.S. economy growing just 1.2% in Q1 2025 BEA, then the next domino isn't just another retailer. It might be the perception of resilience itself. The layoffs at Walmart may be labeled efficiency measures, but experts argue they reflect broader systemic cracks exposed by outdated trade doctrine. Joe Mai, senior analyst at China Markets Review, told Bloomberg that U.S. retail is clashing with 20th century trade tools that no longer map to globalized production. Walmart's reliance on just-in-time inventory, powered by low-cost imports, is misfiring under erratic tariff swings. Meanwhile, internal restructuring aligns with a broader corporate trend. McKinsey's May 2025 data shows 74% of U.S. multinationals are now relocating parts of their supply chains, often at significant cost, to avoid trade volatility. But that shift isn't smooth. It's expensive, uncertain, and already triggering domestic employment losses in high-skill logistics. As retailers recalibrate, the disconnect between political narratives and operational reality is widening, and the consumer sits on the fault line. Angela Nichols, 38. A project manager in Walmart's e-commerce logistics division was let go last week, part of the $1,500 cut in May. I helped Walmart save $28 million last year by improving fulfillment algorithms, she told Reuters. Now I'm comparing Cobra plans with my grocery receipts. Her story isn't unique. According to Challenger Gray and Christmas retail sector, layoffs jumped 215% year over year in April, with tech-facing roles hit hardest. At the same time, the average U.S. grocery bill increased 6.4% from May 2024 to May 2025, driven by tariffs and fuel costs as tracked by USDA. Families aren't just budgeting, they're defaulting. The latest Census Household Pulse survey shows 41% of Americans skipped at least one bill last month. These aren't isolated events. They're cascading signals that confidence, once a soft metric, is now bleeding into hard numbers. Walmart's price hikes, job cuts, and strategic silence weren't acts of rebellion. They were symptoms of a deeper policy misfire. Treasury Secretary Scott Bessent admitted in closed-door meetings per WSJ leaks that tariff-driven revenue spikes are being offset by consumer drag and falling retail tax collections in multiple states. Meanwhile, the CBO now projects U.S. GDP growth will slow to 0.9% by Q3 2025, if current trade restrictions hold, with lower income consumption expected to decline by 3.7%. Walmart did what math forced it to do. The question is whether Washington will revise its model or continue demanding patriotism from corporations operating in a system designed for economic contradiction. Because what happens when the next company doesn't bend but breaks? If Walmart, America's largest private employer and unofficial inflation barometer, can't hold the line, what chance does any smaller retailer have? And more importantly, what policy bomb is coming next? Because buried in a recent SEC filing, one major U.S. company just disclosed a contingency plan for a complete decoupling from China. That's not a forecast, it's a trigger. So hit subscribe, because in the next video, we uncover which industry is preparing for trade war escalation and why it might force Washington to choose between inflation and collapse. We're glad you're enjoying this video. Please like and subscribe. Check out another video that is now on your screen.